Debentures can be redeemed by various methods. The first of these methods is on maturity in lump sum. As the name suggests, in this case, the debentures are redeemed on their due date as the company had announced at the time of issue, and they are redeemed in lump sum. That is, all the money is redeemed together. Now students, this redemption can be done at par or at premium. So what will be the journal entries? Let's say redemption at par is there. When the redemption is done at par. So in this case, the first entry would be that the amount of debentures becomes due to debenture holders. Entry would be debentures account debited to debenture holders, that is number of debentures into face value. Right students, this entry makes sure that the debentures are now cancelled when we have debited them, and the amount on account of these debentures is due to debenture holders. Then when payment is made, in that case debenture holders account debited to bank. This is the amount paid, that is the same amount. Right students, these two entries are done in case when debentures are redeemed at par. There can be a situation wherein debentures are redeemed at premium. Now students, redemption at premium means that you are paying an amount over and above the face value of debentures. So when they are redeemed at premium, premium on redemption is also payable to debenture holders. So the entry is debentures account debited premium on redemption account debited to debenture holders. That is face value here, premium on redemption here, and the total amount here. Then when the payment is made, entry is debenture holders account debited to bank, that is with the amount which is due to debenture holders. So students, in case debentures are to be redeemed at premium, premium is also debited in the first entry and the total amount due to debenture holders is taken out. And later on, whatever date is given in the question, you can make the payment to these debenture holders. Whenever the debentures are redeemed in lump sum, the company may follow any of the two methods, that is, redemption can be done out of capital, and redemption can be done out of profits. Now students, out of capital we mean that the company has not transferred or created adequate reserves to pay out debenture holders as and when they are due for redemption. But out of profit means the company has created debenture redemption reserve, that is debenture redemption reserve, and debentures are redeemed out of these accumulated profits. In case of redemption out of profits, there is one additional journal entry besides the entries that we had just discussed, and that entry is P&L appropriation account debited to debenture redemption reserve. Right, students? Remember, section 117C of Companies Act 1956 makes it mandatory that before the debentures are redeemed, the company has to create reserve, that is debenture redemption reserve, to facilitate their redemption. So this brings us to section 117C. Let us understand in detail about debenture redemption reserve. Students, section 117C, debenture redemption reserve is created in accordance with this section. Now this section makes it very clear that before the redemption is to begin, the company must have transferred adequate profits to debenture redemption reserve. Remember, there is no stipulation in the act as to what or how much amount should be transferred. But the SEBI guidelines are very clear. The SEBI guidelines clearly stipulate that 50% of face value of debentures should be transferred to DRR before the redemption can commence. Remember, there are few exceptions to this rule. That is, exceptions for creation of DRR. For creation of DRR stands for debenture redemption reserve. The exceptions are that for infrastructure companies, the companies which are involved in the development of infrastructure. For such companies, whenever they will redeem debentures, creation of DRR is not required, or the basic condition for DRR creation as stipulated under section 117C does not apply. And the second exception is in case of debentures redeemable within 18 months of date of issue. That is, when debentures are to be redeemed within 18 months, that is 1.5 years from the date of issue, then also creation of DRR is not mandatory.